The factory gates at Maranello, the test track behind them, the prancing horse, and the right to stamp that badge on anything you please. Not a Ferrari. Ferrari itself, the whole company. The order book you'd inherit runs years long. Customers line up to hand you money, and the brand is strong enough to sell on a coffee cup. Mostly, that's true. Then comes the number that should stop your hand before you wire a cent. In 2025, Ferrari shipped 13,640 cars, fewer than Toyota builds in a single day. And as of July 2026, the market values the company at around $67 billion, more than Ford, which builds well over 100 times as many cars. Everyone knows Ferrari is a great brand. What is genuinely strange is that a company that flatly refuses to grow is worth this much. Four levers make it true. Let's walk it the way a buyer would. Start by throwing out the thing you think you're buying. This is not a car company. Ferrari's own chief executive, Benedetto Vigna, said so on CNBC in July 2024, almost impatient with the question. We are not an automotive company. We are a luxury company that is also doing cars. One number proves he means it literally. The operating margin, the share of revenue left after the actual cost of running the place. A mass car maker like Volkswagen runs about 6%. Toyota, one of the best run in the world, runs around 10%. Ferrari, in its 2025 full year, ran 29.5%. No car maker on earth runs a margin like that. It lands between LVMH, the house that owns Louis Vuitton, at about 23%, and Hermès, maker of the Birkin bag, at about 40%. So think of Ferrari less as a fast car company and more as a luxury house that bolts engines onto its product. Which leaves the question a buyer actually asks next. What does a house like that cost, and what do you get for the money? The machine runs on about 7.1 billion euros of revenue in 2025, up 7%. Look at how it grew though. It didn't sell more cars, it sold 112 fewer than the year before, and grew anyway by selling richer cars to richer buyers. The core engine is the line Ferrari calls cars and spare parts, about 6 billion euros of that revenue. Now the price of admission. At that July 2026 valuation, you're paying about 67 billion, and you're paying around 40 times the company's profits for it. An ordinary car maker trades at high single digits to the low teens. Something close to 40 is what the market pays for Hermès. So you'd be buying Ferrari at a luxury price, on car company hardware. And a serious buyer checks one more thing before signing. Even at that price, you would not be in charge. The Agnelli family's holding company, Exor, together with Piero Ferrari, Enzo's son, controls something like 30% of the shares as of early 2026, but close to 48% of the votes, because Ferrari runs a loyalty voting scheme. Hold your shares 3 years or longer and your votes double. That's just shy of a formal majority. But the rest of the stock sits with thousands of ordinary holders who rarely all turn up to vote, and a shareholders' pact binds the family block together, so effective control never leaves the room. You can buy the economics of Ferrari. You cannot buy control of it. The scarcity runs deeper than the cars. They ration ownership of the company the same way. How does a company that sells so few cars make so much? 4 levers. The first lever is scarcity, on purpose. Enzo Ferrari's old rule, the scarcity gospel management still preached at its October 2025 Investor Day, was to always sell one car less than the market demands. They mean it literally. The order book right now is sold out into the end of 2027. Demand runs roughly 2 years ahead of what Ferrari will build, and Vigna keeps that wait at a deliberate 20-odd months. Shorten the wait and you'd have to build more cars. Build more cars and each one gets a little more common. A more common Ferrari is worth less. So they leave the line exactly where it is. The waiting list is the product, engineered and held there on purpose. The second is allocation. The cars people actually dream about can't be bought at any price. Take the Daytona SP3, 599 of them, roughly $2.25 million each, invitation only, offered to existing Ferrari owners before the public ever laid eyes on it. No one buys their way in. Only loyalty earns the invitation. To protect that, buyers of those halo cars, the flagship limited runs, reportedly agree not to resell for a period, and Ferrari holds the first right to buy the car back. It reads as heavy-handed until you see the point. It's asset management. Every restriction protects the value of the cars already out there, and that loyalty runs a loop that feeds itself, one most owners never see. Ferrari sells cars, and alongside them it cultivates a client list, a pyramid where you earn the right to be offered the next limited car by having bought the last several ordinary ones. Its 2030 plan treats that client base as the asset to grow, steering its active clients toward roughly 90,000. Read the target the way an owner would. The company's growth plan is aimed at the membership itself. What you'd be buying is a members club that hands out automobiles to the people who've earned their place in line. The third lever is the quiet one, and it does the heaviest lifting: personalization. Buried inside that cars and parts line is the most profitable thing Ferrari does: bespoke paint and materials, one-off commissions through its tailor-made program. By most estimates, personalization runs around 20% of car revenue now, up from perhaps 15 or 16 a few years ago, though Ferrari doesn't break the number out as a formal line. So roughly €1 in every 5 of car revenue is options, sold at close to pure margin. That's how the average price of a Ferrari keeps climbing while the number of Ferraris barely moves. The fourth is the roughly 10% of revenue that isn't cars at all: Formula One prize money and sponsorship, licensing, merchandising, even renting Ferrari's engines to other teams. That line grew from €670 million in 2024 to €820 million in 2025. And it earns that on almost no capital, because Ferrari licenses its name instead of building anything. The Ferrari World theme park in Abu Dhabi? Ferrari doesn't own it. So before you fall in love, price in what the scarcity costs, because the same scarcity that prints the money is also the cage. The first risk is that Ferrari has capped its own ceiling, refused to sell more cars, and every euro of growth has to come from price, richer mix, and personalization. There's a limit to how far that stretches before even the faithful flinch. Management's own 2030 plan targets only about €9 billion of revenue, with operating profit before depreciation, or EBITDA, of at least €3.6 billion, and a margin holding above 40%, but only about 5% annual growth to get there. Only 5%. You'd be paying a Hermes-sized multiple for a company that has promised, out loud, to grow slowly. The second is the live one: electric. Ferrari's first EV, shown under the working name Elettrica and now badged Luce, due late 2026, drew what the press widely called a divisive reception. At that same October 2025 Investor Day, management cut its 2030 electric target in half, from 40% of sales down to 20%, and quietly reaffirmed it would keep building 12-cylinder engines. Which brings us to the day the market showed its whole hand. On October 9, 2025, Ferrari laid out that slower, less electric plan, and the stock fell about 15%, in New York and in Milan alike. Its worst day since it went public. Somewhere around $15 billion of value, about €13 billion, gone in a single session. Nothing had broken. The market simply heard, "We are going to grow even more slowly than you thought." For a company priced entirely on the promise of luxury growth, that one sentence was worth $15 billion in the wrong direction. The third is unglamorous and real. About a quarter of Ferrari's sales are in the United States, and 2025 tariffs pushed the company to raise US prices roughly 10% and absorb about a half-point hit to its margin. A cost to carry, not a crisis. A sentence only costs you $15 billion if the market has already decided you're worth a fortune. So how did a company priced like Ford in 2015 end up priced like Hermes in 2026? When Ferrari was spun out of Fiat Chrysler and listed in New York in October 2015, ticker RACE, $52 a share, it was valued at about $10 billion, priced like the carmaker everyone assumed it was. The late Sergio Marchionne, who ran that spin-off, did one deliberate, slightly ridiculous-sounding thing. He told investors to stop comparing Ferrari to Ford or BMW and start comparing it to Hermes. A decade later, Ferrari is worth roughly $67 billion, 6 to 7 times its IPO price, on very nearly the same number of cars it built back then. Nothing about the product got 7 times bigger. The story did. The market slowly conceded that Marchionne had it right: a luxury house wearing a car company's overalls. So put a number on what you'd actually be buying. Ferrari shipped those 13,000-odd cars in 2025 and booked about €2.1 billion of operating profit on them. Divide one into the other. This next figure is our arithmetic, not a number Ferrari publishes. Roughly €155,000 of operating profit, and about €117,000 of net profit on every single car it sells. A Volkswagen or a Toyota clears somewhere between €2,000 and €3,000 or so per vehicle. So Ferrari earns, on one car, what a mass car maker earns on something like 45 to 70 of them. Treat that as order of magnitude, not to the euro. But it is the whole company in one line. Cap the cars, sell the scarcity, book a luxury margin on a product that happens to carry an engine. And the market prices it exactly that way, at a luxury multiple instead of a car maker's, which is the only reason a company building 13,000 cars can be worth more than one building 4 million. So here's what's actually on the table. You can buy the single most profitable way anyone has ever found to sell a car, a margin that belongs in a fashion house, and customers who wait 2 years and thank you for the chance. You'd also be buying a family that takes your money and keeps the keys, running a company whose entire published strategy, restated calmly every single year, is to stay smaller than it easily could be. Every business instinct you have will scream to fix that. Build more cars. There's a 2-year line out the door and each one earns 150 grand. Give in and you'd understand what you bought on the same day you broke it. The refusal to grow is the product. It's what the $67 billion price tag buys, and it lasts only as long as the refusal does. Own Ferrari, and you'd own every car it builds. But walk back past those Maranello gates, past the 2-year order book you'd inherit, and you can finally see it. The money was always in the ones it won't.